How hard is it to get out of that asset or sell that asset if you really need to? Shares obviously is much easier to get out of, so you can sell them quicker because you can put a sell order in and have the money back in your account within 3 days. Certain shares will pay dividends, so when you're investing in these companies, they make profits, and then they also pay what's called a dividend, so they share those profits with the shareholders after the tax has been paid at 30%, so it's called a fully franked dividend. And with property, you also have income, and that's called rent. That also gets paid, and typically that rent will be used to service the loan. If you're happy to take on debt and borrow money from the bank to purchase an asset, then perhaps property might be more suitable for you. But if you're not willing to take on debt and you are okay with volatility, then shares might be the right option for you. Welcome to SMSF Insider, where we help busy professionals to gain financial independence using an SMSF. Hi, I'm Troy, founder of Blue Chip SMSF Services, and over the last 20 years, I've helped thousands of Aussies manage the complexities of self-managed super funds. And in this podcast, I'll answer your questions, break down the myths, so you can take charge of your financial freedom. Let's get into it. Just a quick disclaimer and just a reminder that this is not personal advice, so make sure you speak with a licensed advisor before making any investment decision. Hi, welcome to SMSF Insider, where today we'll be talking about property versus shares. It's good to have a bit of diversification in your portfolio. It doesn't matter whether it be property or shares, but it's good to have a bit of both. But if you could only choose one, which one would it be? So there's a few things we should talk about before making any investment decisions, and that is, what are the pros and cons? So with property, typically you can get some gearing. So you need a maximum. You could have anywhere from 10 to 20% deposit. So let's work on 20% deposit. So if you're buying $1 million property, for example, at the moment, you'd need $200,000 to purchase that property. That gives you $1 million exposure into the market. So that if that property went up 10%, for example, over a 1 or 2 year period, that would mean the property goes from 1 million to 1.1 million. That's a fairly typical scenario in today's market. With shares, however, if you had a $200,000 share portfolio, so you take that same $200,000 and you invest that in shares, that property, that share portfolio goes up by 10%, so the same amount. Your $200,000 turns into $220,000. So you've made $20,000 as opposed to $100,000. Now, yes, there are costs with property, of course. So you've got stamp duty implications, and you also have sales costs when you sell the property. But that's only when you sell. So over time, that $1 million, if that compounds over the next 10 years, and you continue to get those types of returns, even if it's 7% return, then you've got 70,000 compounding over a 10-year period, as opposed to the 200,000 that's compounding at 7%. So you're only getting $14,000 compounding over that same period. Then I think long term, the property would outperform when you add the gearing in there. Of course, when you're talking about no gearing, then that's a bit of a different story. But most property investors have gearing. They when I say gearing, they have a loan attached to them, and that's where the lending or the gearing can be quite a powerful tool to use. So that's the difference. But when you're talking about returns, there are, of course, costs of getting into a property and getting out, and liquidity as well. When I talk about liquidity, how hard is it to get out of that asset or sell that asset if you really need to? Property, of course, can be a lot slower in certain markets to get out of, whereas shares obviously is much easier to get out of, so you can sell them quicker because you can put a sell order in and have the money back in your account within 3 days. So it is easier to get in and out of shares, and that's called liquidity. And property is a little bit harder to get in and out of. But over the longer term, when you do add gearing, property can be quite a powerful tool. So, and I'm not saying that you should choose one over the other. I'm just trying to explain the difference so that viewers can make up their own decision around what asset class may be more suitable to them. So with shares, you've obviously got certain shares will pay dividends. So when you're investing in these companies, they make profits, and then they also pay what's called a dividend. So they share those profits with the shareholders after the tax has been paid at 30%. So it's called a fully franked dividend. And with property, you also have income, and that's called rent, and that also gets paid, and typically that rent will be used to service the loan. So when you've got a loan attached to the property, you will be required to pay interest on that loan, and typically that rent will be used to pay the interest on that loan. So there are a couple of differences, obviously, between the two asset classes. It is great to have a bit of both, but certainly I think property, when you do add the gearing in there, is a very hard asset class to beat. But certainly make sure you're touching base and talking to an advisor before you're making any investment decisions. Just quickly, guys, if you're a busy professional, fed up with traditional super funds and overwhelmed by the setup of your SMSF, we can help. Book in a call with my team using the link in the show notes, and let's build your future on your terms. Now, back to the episode. Some cons with property being it's a little bit more illiquid, and you've got costs like stamp duty costs and sales costs when you're getting in and out of the property. With shares, there are some cons as well, and that is volatility. So it is very much, shares are very much more of a volatile asset class. So when I say volatile, they do go up and down a lot more than what property does. And it is obviously, it's not tangible, so you can't see it. It's basically just on paper. So the main one being volatility. Shares do go up and down quite a bit, and if there is a market crash, your portfolio is affected almost instantly, and sometimes even before there's a crash. Just some news can crash a market. So there is definitely more volatility with shares than property, and that is mostly because property isn't valued at a specific point in time every second of the day, like shares are valued every second of the day. Property, however, isn't valued every second of the day. It's only valued when you call a valuer and go and ask the valuer to go and value the property. So that's why shares are typically considered more volatile. But thought I'd just mention that the cons around shares as I have done so with property. So as a whole, who is this targeted towards? So which one is going to be best for you? That will really depend on what your individual circumstances are. So if you're happy to take on debt and borrow money from the bank to purchase an asset, then perhaps property might be more suitable for you. But if you're not willing to take on debt and you are okay with volatility, then shares might be the right option for you. But certainly a lot of people, when it comes to property, everybody needs somewhere to live, and there seems to be a shortage of it. So you really just need to consider what is best for you. So reach out to your advisor, and they'll help you go through and help you make that decision, which asset class is going to be best for you. So while we're on the topic of shares versus property, which asset class is easier to purchase? Well, in my opinion, shares are probably much easier to purchase. You can jump on the exchange, talk to your stockbroker, and purchase shares pretty quickly off the exchange. Property, however, can take a bit of time to get into. So you need to firstly find the area you want to buy into, the type of property you want to purchase. There is a shortage on property, it seems, in Australia at the moment. So it is a bit harder to purchase property than shares. And that's probably why I think property is performing well at the moment, because does seem to be a shortage. It's the same old demand versus supply. So when it comes to purchasing assets, property versus shares, which one's easier? Definitely, in my opinion, shares are much easier to purchase than property at this point in time. So while we're here talking about shares versus property, I thought we'd briefly touch on the tax implications of both asset classes. If you hold a property for less than 12 months, which is probably unlikely, but if you do, it's 15%. If you hold it for longer than 12 months, then the tax rate is 10%. And of course, if you hold it all the way through to retirement, it's 0% capital gains tax. With shares, it's taxed the same. However, shares are sometimes they're traded a little bit more frequently, so you just need to be careful when you are buying and selling shares, if you do sell them inside that 12-month period, they'll be taxed at 15%. The idea is to, when you're purchasing some of these assets, it is insider super, then it is a long-term strategy. So holding it for longer than 12 months, shares again will be taxed at 10% after the 12-month period. And again, if you hold them right through to retirement age, the capital gain on those shares will be 0% when you're in pension phase. So just thought I'd just explain the difference in taxation between the two asset classes. They're actually taxed identically, but it just means that, but with property, typically it is held more than 12 months, whereas shares can sometimes be bought and sold within that 12-month period. So just be mindful of that. Reach out to your advisor. I'm Troy from SMSF Insider. Thanks for listening. Thanks for tuning in to this episode of SMSF Insider. If you got value from this, make sure you subscribe so you never miss the strategies we share to help you take control of your financial future. Find us on socials at Blue Chip SMSF or book a call with our team to see if we can help you.